Hello, and thank you for joining us for today's webinar. Jackie and I are excited to share the semi-annual market update. The last time we were able to share this update with you all was about 6 months ago, and a lot has happened since then, which we're going to cover and share a lot of insights with you as well from what we've heard from our clients. Before we get started, we'll just introduce ourselves briefly. My name is Amol Dhargalkar. I'm the chairman and managing partner at Chatham.
Hi, my name's Jackie Bowie. I'm also a managing partner of the firm and head of Chatham's EMEA business.
And so Jackie and I will be giving one another a hard time between what's happening in Europe and what's happening in the US. Before we begin, a quick reminder that swaps have risk, as we're required to tell you under the Dodd-Frank Act. And another administrative reminder, for those of you that are looking for CPE and CTP credit, please make sure you stay for the entirety of today's event. We'll have 4 polling questions. We'd love for you to answer all 4 of them, but you need to answer at least 3. And certificates will be available in the widgets after the event is concluded. For those of you that have joined and aren't quite as familiar with Chatham Financial, we are the world's leading financial risk management advisory, capital markets advisory, and technology solutions firm. We work with over 3,500 clients globally. We've been around in business for over 30 years and are proud to be able to share the insights that we've generated through all of the transaction volume that we see, that we've advised our clients on, that we see going through our system, both on the derivatives and debt side. In terms of our agenda, we're going to start with a quick look at the macroeconomic data that's out there that's really impacting some of the decisions that central banks are making or are in the process of making as we speak. And we'll talk a little bit about the interest rate landscape as well as looking at global FX trends. And then finally, we're going to conclude with 3 actionable strategies that we're seeing our clients take in the market today, given all that's happening within their businesses and all that's happening in the markets.
Right. And with a little bit of a change to the usual order of our lineup, we're actually going to start with a poll question today, just to get your brain engaged as we kick off. Lots of the things we'll talk about today around GDP growth, around inflation, there's a lot of stories about automation, AI, what the impact will be. And we're hearing it from businesses every day, but we wanted to hear it from you from the bottom up. So we're starting with the poll question. In which area of your organization are you adopting AI? You can only choose one, so you choose the one that's kind of most dominant or the highest priority. So the answers are either A, for monitoring portfolio performance, B, to streamline financial reporting workflows, C, to help synthesize relevant insights, or D, for data governance. So we'll give you a few minutes to get your answers in, and then we'll kick off with the macro overview.
So, Jackie, let me ask, for our audience, how do you use AI?
So I probably don't need a large language model, I have to say. I could probably just be doing with a simple language model. So yeah, I use it every day. It helped me plan holidays, recipes, food shopping. But on a more serious note, we're seeing it throughout our business here at Chatham, and certainly through our client businesses as well. And I think the challenge they have is, where do they focus those resources to get started? So that's what we're hoping to hear from the responses.
Yeah, I think so. And I'm going to push this forward. Hopefully, everyone's able to put their responses in here as we go through this. But I'd say synthesizing relevant insights has been really interesting. I've certainly used it by taking a lot of data that comes in, bank pitches, other things like that, and when you don't have time to read the 90-page deck times 5, to really try to distill it down and get some quick actionable insights, I think is really helpful. So as we go through here, looks like we've given the audience a chance to respond. And okay, synthesizing relevant insights. Yeah, that's a great one. But also streamlining financial reporting workflows, which as we know, has been a constant challenge for all of our clients, especially as there's more and more and more expected of the financial reporting packages that go out to investors.
Yeah, but I think your point about the insights is right. We're just bombarded every day with so many things that we think are relevant for our business, and we can't possibly consume them all. So I would agree with the majority of our respondents too.
Yeah. With that comment, let's talk a little bit about how the some of the major economies here that we track have been doing over the last few years. As you noted, Jackie, I mean, of there's certainly been a lot of growth, particularly in the U.S. We've been holding strong in the face of headwinds over the course of the last few years, whether it's inflation, rising rates. Uh, CapEx in some places has been going down, but unquestionable. You and I were just talking before the webinar started about the insatiable demand for data centers and AI connected, you know, solutions, products, CapEx. Continues to really, at a minimum, lift up the U.S. economy, but at a maximum, maybe send it into a different trajectory. But going forward, we're not quite expected to grow at that same, above trend rate of growth. We've been, averaging north of 2.5%, which is, I think higher than most economists would expect in the U.S. But when we look at the EU and the UK, I think the forecasts start to converge going forward. The last few years have looked very different than the U.S.
Yeah, and it makes me kind of smile a little when people are so negative about the US growth outlook, when actually it's still forecast to be quite a bit better than what we're going to see in the UK and also in the EU. And while some of those growth projections, so there was a bit of excitement in Europe this year, particularly when Germany announced the fiscal boost. But we really haven't seen any of that come through. And some of the forecasts that we're now seeing out to 2026 are saying it's really not going to have a substantial impact. So when I look at these forecasts for EU and the UK, I feel the biases to the downside, and there's a couple of reasons for that. If we take the UK as a standalone country, we have another budget looming on the 26th of November, the day before your Thanksgiving here in the US.
We'll celebrate for you.
Yes, I feel we won't have much to be thankful for. So the expectation is it's not going to be a growth budget. So again, I would suspect that some of these forecasts for UK GDP are likely to come down. When we look at the EU as a whole region, obviously this is what this number shows, but you need to scrape behind that a little to really look at what's happening in the underlying countries. Taking Germany as the example, is a very export-led economy, so much more impacted by what's happening with those global headwinds that Amal mentioned, versus like Spain, for example, where much more kind of domestic, service-driven, tourism-driven, who are performing slightly better. All across Europe and the UK, and also in the US, but for slightly different reasons. Of course, we also have this trend around the general fiscal position, concerns over the budget deficits and how these governments are not making inroads into getting those deficits down. And we've seen just in the last few weeks the credit rating agencies downgrading France as a sovereign debt at the same time as increasing Italy's credit rating. And you might say, well, but they both have huge budget deficits. Like the thing to take away is that France and the UK, to some extent, are not showing any indications that they're going to get that debt under control, whereas Italy have made some inroads into slightly more fiscal prudence. So whilst this, we're talking about GDP and growth, I don't think we can talk about that without really putting that fiscal and sovereign debt position at the top of the worry list.
And of course, in the last 6 months in the U.S., we passed an extension of the tax cuts, and certainly there's some arguments that it will unlock so much growth that it will, improve the U.S. fiscal position. That's certainly not a mainstream view, I would say, from most economists, and there's probably something for us to be paying attention to in the U.S. and seeing how some of the economies in the EU were challenged several years ago, and how they made some difficult decisions and some adjustments, and how that's impacted things. And I like how you mentioned that while the credit agencies may have downgraded France, I think even more instructive is to look at actual sovereign bond yields, which tend to move ahead of any agency's decisions.
And I should say we are getting some questions in already, so please feel free to put them into the question box. We'll try and answer them as we go if they fit our theme, but if not, we'll certainly come back at the end. So there are some questions coming in which we're going to be covering off, so I'll wait to answer them when we get to that slide.
Great. Well, I'd mentioned inflation earlier. Inflation, uh, in some ways, we could have cut off the last or the first few years of this chart, Jackie, but it's a nice reminder for us as to where we were just a few years ago. I mean, we were looking at inflation, 8% plus in the U.S., double digits in the U.K. and the EU, and my very positive take on where we've come is that we've come a pretty long ways from that. Now, the challenge is, of course, this last mile on inflation, and we'll certainly talk about this as it relates to the Fed and other central banks. But this last mile on inflation is proving to be a very let's call it a treacherous journey at this point. It is not a fun one. And at this moment, from the U.S. standpoint, and while the Fed doesn't look at CPI, they look at personal core expenditures. There's some differences. We'll spare you the details, but generally, all of those are running slightly north of target. If target is 2%, PCE is running 2.75% or thereabouts, and on one hand, it's a solution to the sovereign debt balances that we have. We can, just slightly higher inflation can inflate it away, and maybe no one will notice. But I'm not quite sure that's the case with investors. Particularly as we've continued to get headlines in the U.S. about sell-offs in 30-year bonds and longer-term bonds, indicating that maybe investors are concerned. But again, the inflation picture is actually markedly different in both the UK and the EU here.
Yeah, and whilst the growth story for the EU is a more kind of negative one, on the positive side, they certainly have managed to achieve that reduction in inflation, getting to the 2% target. And in fact, there's now I've seen some economists started to forecast or at least put some risk that they may undershoot the inflation target next year, so below that 2% level. But to your point, Amal, the fact that we've come from these extremely high levels of inflation down to, in the UK, call it kind of 3.8 to 4%, seems like a good achievement. My argument to that is that a lot of the reduction has really come just through the change in the base effect. When we think about where that inflation arose from, very much an external shock factor, the UK around, we're an importer of energy, and that then gets reflected when Russia invaded Ukraine. What we're seeing now is actually, even though inflation is lower than those heady rates that we had a few years ago, it's actually a more concerning trend because that last leg down in inflation is much more embedded into the domestic economy, which makes it much harder to remove it. When we start to look at inflation expectations, you see it in the wage cycle. And the one key little kind of anecdote, if you want to monitor it in the UK's food pricing. And gone are the days of the supermarket wars where everyone is cutting pricing to win market share. The food price inflation in the UK is a real concern, and everyone has to eat, right? So everyone is impacted by it. And I think that when we get on to talk about interest rates, that will be the theme that will come through that. I think the central bank is in a real tricky spot with regard to this inflation still up at kind of 4% against a potential target of 2%.
And we actually have a question about this. So why do central banks not adjust their inflation targets to a range rather than a fixed number? 2% was based on previous near zero rate environment. Should an inflation target be adjusted accordingly? A bit of realism, I think. So yeah, I think there's a lot there. I will say, historically, that 2% target was before the zero rate regimes really took effect. And in the US, there was this concept of average inflation rate targeting, if you remember that. That has certainly gone by the wayside. And the idea there was if we undershoot the target for a little bit, it's okay to overshoot for some period of time as well, because you can't quite dial it in perfectly to 2%. Obviously, that had I don't want to quite say disastrous results, but certainly there's some unintended negative consequences with
Sure.
that average inflation rate targeting. But what are your thoughts?
Yeah, and it's very similar in the EU. If you look at the statements that come out from the ECB, they will make statements around we're kind of willing to tolerate inflation at below the 2% target or slightly above. So whilst it's not an explicit range, there's, as I say, the word they use is tolerance. I think there's actually a bigger question here, which is any movement of the target to either a range or a different level altogether, I think starts to really question central bank credibility. And we'll probably touch on that a little bit as we go through this too. When you think about, I remember when the Bank of England was made independent, just to reveal how old I actually am. And it really was to boost, it was getting away from the super high inflation that we'd had before that and to really give financial markets and consumers comfort that inflation would remain a focus. So any change does have repercussions for that. But again, good question and a good observation.
Yeah. Well, let's keep going. Let's talk about before we get into central banks and the nightmare that they are seemingly never able to escape right now. Let's talk about some of the other factors that really drive their decision making and unemployment rates. Certainly in the U.S. with the dual mandate is a critical one. Now, if I had told you a decade and a half ago that we'd be worried with inflation running in the low fours, I think in the US, everyone would look at me like I had three heads, right? I mean, this was already lower than what people expected the economy to be able to handle and tolerate. Of course, we've been in the threes for a meaningful period of time. So the unemployment rate has been increasing in the US. On the right-hand side, we have a chart with job openings per employed per unemployed per individual. And if you look, at remember back when everyone was, able to get like 3 job offers without even trying, and
Yes.
we read all those stories of people working like 2 remote jobs at a time or more. That was even before they could use AI. Who knows what it would look like now? But it used to be two. That ratio was phenomenally high at 2 job openings per unemployed person. We recently cracked if nothing else, a psychological barrier of under 1 job opening per unemployed person. With the recent data revisions that have happened in the U.S. Employment statistics, the narrative is finally matching the data. And we are seeing, a more challenged labor market in a variety of, different pockets. Uh, Again, it's not a terrible labor market. Most people, 96% almost of people who want to, have jobs and are looking for jobs are able to have them. So it's nowhere near the, financial crisis or anything along those lines. But that trend is, unequivocally up in terms of the unemployment rate. The stories maybe the EU story is a little bit different in that it's been flat to down, but there's some structural factors there that really make
For
it
sure.
difficult to compare, I think.
Yeah, and I would say there's a nice little phrase that I've heard people use across the EU and the UK at the moment, which is we've gone from that period of, do you remember in 2022, the great resignation?
Yes.
It's now the great, I think I'll stay where I am. And that gives you a good kind of sense of the kind of the vibe in the employment market. But yeah, Amal, when you look at the EU unemployment versus the US and the UK, it doesn't look great because the line is much higher. But ultimately, that's a fairly stable picture. Unemployment at about 5.9 to 6%. But yeah, structurally, if you look behind that, again, the individual country differences are pretty stark. I used Spain as the example before around the GDP situation. But if we use that in looking at the unemployment rate, there are extremely high levels of youth unemployment in Spain, youth being defined as anyone between the age of 16 and 24. And it's up, well, the measures are difficult to rely on. We'll come to that, but kind of high teens, low 20%. And that is another concern for kind of long-term health of the economy when you have youth unemployment as high as that. In the UK, again, we've seen this slightly creep up, and this whole point that people are just a little bit more nervous about job openings. And the situation in the UK is more about what we call economically inactive. So these are people who are not registered in the unemployment numbers because they are not actively looking for work. And the current estimate is that some 10 million people. So, in terms of the employable workforce, you have about 1.7 million people who are unemployed and in these numbers. And then you have about 10 million people who are of working age who are choosing not to work. And when we talk about how do we get that GDP growth off that 1%, 1.5% level, it really does come down to productivity. And being slightly cynical, I would say, well, AI could potentially do a lot, but if people are not working, then there's no one to deploy the AI. So a little bit of a cynical view, but I think in terms of looking forward, there's definitely concerns that that lack of productivity growth across Europe and the UK will be what holds the labour market back as a whole.
And a few other things to highlight. I mentioned and Jackie referenced some of the reliability of the statistics. It's worth noting that I think economists are increasingly trying to find alternative data to help give a fuller picture of the employment and frankly, other major economic data as well. One thing to be on the lookout for, we won't spend too much time on this, there's the possibility of a government shutdown in the United States right at a time when the Fed will continue to meet. And one consequence of a government shutdown could be delayed or even lower reliability in some of the economic statistics that different government agencies put forward. So something to keep an eye on. The other area to keep an eye on is what job growth we need in the U.S. to keep the unemployment rate in this low fours range. Fundamentally looks different going forward than what it has in the past. I think as market participants, we've been conditioned to seeing a non-farm payrolls print of six figures plus 100,000, plus 80,000, plus 120 as what we need. But even as recently as I think earlier this week, the U.S. official estimates of net immigration into the U.S. for this year in January, it was expected to be plus 2 million people, and now the expectation is plus 400,000. And to be clear, this is legal immigration coming to the U.S. So that's 1.5 million fewer people that. Probably not all of them were going to your point, enter the labor force. But even if it was 2/3 of that, which is roughly the employment labor population, for the rest of the U.S., that's 1 million people that don't need to find jobs because they will not be entering into the U.S. labor force, which is a reduction of about 80,000 a month. So we can have lower job growth and still maintain an unemployment rate roughly in this level. The other big thing that we should talk about before we get to our next polling question that's happened in the last 6 months is tariffs. If you stick around to the end, Jackie and I will give you our crystal ball of what exact tariff rate is going to be by each individual country and good. It might take a little bit longer than an hour. No, I think this has been, of course, I think unstable ground for our clients and for investors on which to make decisions. We're showing the import price index, giving you some sense of, whether, and the producer price index, trying to give some sense of whether these tariffs are actually being passed on, from producers outside of the U.S. To companies and firms that are acquiring those goods, and then ultimately to consumers. I think the best answer from a U.S. consumer standpoint is some of the tariffs are being eaten by producers. Some of them are being eaten even downstream in supply chains, and some of them are being passed on. We can't quite apportion that. There's no strong enough data that says this is the exact apportionment. Economists still believe that this is likely to be a one-time effect on inflation. It's just that the effect is being drawn out. It's not as though in the month of April all of that effect was felt all at once. So worth keeping an eye on. I think our view is that essentially, particularly equity markets, have essentially underwritten some normalization of trade and tariffs. to sub some of the sensational numbers that we've seen bandied about. But that's the U.S. perspective. Apparently, there's a whole other world out there, Jackie, that's thinking about this.
Yeah, so if we look at this more through a kind of global lens, I suppose in some of the questions that we've had, which are absolutely make sense, is given how big the announcement was and how much like even stock markets reacted, you would have expected this to have had a bigger impact economically. So why has that not happened? And Amal's touched a little bit on some of that. There certainly has been a slower pass through, and certainly from a European business perspective, there was quite a lot of kind of front loading before the tariffs were taking effect. So any impact is then kind of pushed further out. But we're really focused on everyone's focused on the headlines, what's been officially dubbed the flick of the pen risk in the market, and how people should react to that. But I think if you zoom out from just what's happening in the US and say, what does this actually look like for global trade if we look kind of 3 or 5 years ahead? And we go back to Trump's first term, which, his policies were the same, maybe not quite as kind of draconian as what's been implemented here. But global trade didn't fall off a cliff. It didn't. It just moves around as people start to reroute, kind of change where things originate from. And I think if you're looking forward 5 years, where I would be focusing is where does all of that surplus that China is producing, where is that ending up? Because they are still producing a huge amount, way beyond what they can absorb domestically. And I seen some good coverage of this last week, actually, from a really good UK economist. And they were saying that, something like a third of Chinese manufacturers are actually loss making, but it is tolerated because they want to just keep producing for the world. So those goods have to go somewhere. So maybe look away from the headlines of what's coming out from the US administration and say, what will the global response be to those countries that are going to call it that glut of what's coming from China? So potentially a complete reshaping of global trade, but not a fall off. So from a rest of world perspective, that would be my focus.
Yeah, I think globalization will continue. It's what it looks like, to your point, half a decade from now might be a little bit different because of some of these changes. With that, we're going to actually get to our next polling question, and I'll read this one out loud for everyone. We ask this every time, and we're going to give you some results from past ones here. But what will happen to the yield on U.S. 10-year Treasuries from today to the end of 2026? So looking out about 15 months. And A, decrease of 50 basis points or more. B, decrease of 25 basis points. C, stay the same. D, increase of 25 basis points. Or E, increase of 50 basis points or more. And when we looked at the data from the last few times we've asked, it was kind of interesting.
Yes, so we obviously asked this question in the March webinar and then last September. And yeah, so one time we asked it, the audience was being spot on and got it pretty much dead right. But the previous time we asked it, not so, kind of a little bit more than a little bit off. I think the key thing though is it's difficult, right? Because we're asking people for a point number. And the reality is, it's what matters in between today and that end of 2026. So your point number might be correct, but you could have had a lot of movement in between. And that's what we've seen last September. Right?
Yes. Yeah. I think last September, our audience, I'm sure it's nobody in this audience, but our audience expected rates to go down, I think, by about 25 to 50 basis points. And we're actually up. About 50 basis points from about a year ago. And so it's a great reminder. And it's some of the things we'll talk about a little bit later today is this changing nature of the yield curve and some of the increased volatility, what that implies for some of the strategies that firms are using.
Okay. So let's see what our audience say. So still the majority, in fact, the overwhelming majority sitting in that expectation that yields will come down on the 10-year. And I wonder how much of that is influenced by the expectation for just short-term interest rates. And we'll come on to kind of central bank moves and decisions on what the forward curve is currently pricing in. My little caveat to this would be whilst rates in the US may be cut again, Amol will tell us. Yields can behave quite differently, and this emphasis about the fiscal position, I don't think can be ignored. And I may be biased because it's really bad in the UK. And we've had a question, which is basically, is it a sovereign debt crisis coming in the UK? I'll get to that when we move a little bit further on. But yeah, what's your take on the results?
I'm not surprised. I think there's also always this. I think there's a lot of talk about rates going down, and I think there's also a lot of desire for rates to go down, regardless of who you are. And so, in spite of all the inflation talk, I think I'm not surprised by this. And with 2/3 of our audience expecting it, I look forward to coming back in a little bit of time and sharing with you how prescient you all were. So. So with that, let's, as Jackie mentioned, we should spend a little bit of time talking about the Fed. I previewed this. I mean, this is a nightmare. If you are Chairman Powell, I have to assume, if you asked him, like when he took the chairmanship job and he said, hey, what are like some of the worst things you could imagine happening? Inflation, sovereign debt, concerns, undisciplined fiscal policy, some jawboning by the executive branch and others. I mean, this is a tough place to be in, all with a weakening labor market. And potentially, to our discussion of AI, a generational shift that is about to happen, or that we might be at the early stages of. Navigating all of that, I mean, you can argue that's what he's paid to do, but certainly, I mean, this is a real challenge. And as we look forward to not just what's going to happen in the next few meetings, certainly the market's expecting rates to be cut. What will happen next year with the voters that are currently in place? Unclear whether they will remain in place. I mean, there's a very strong kind of balance, if you will, between those that are really focused on inflation and those that are very focused on employment. Stephen Moran, the newest member of the FOMC, voting member, believes that the neutral, Fed funds neutral rate should be in the twos. So we're 200 basis points higher than where it's where he thinks it should be. And while no one says, who the individual members are when you look at a dot plot, and we haven't shared that this time, I think we can surmise that he is probably the lowest dot on that dot plot, calling for rates to be cut significantly even this year. But we'll see what happens next year, and there'll be a little bit of drama and noise around whether Powell. I mean, no one's expecting him to be, let's say, renominated to be the chair. Yeah. But he has the opportunity to remain on as a voting member of the FOMC, even if he is not chair. So we won't make guesses as to how that will all play out. But we will share this data, which is what the market's expecting the Fed to do over the course of the next few meetings. Right now, as a reminder, the target rate is between 4 and 4.25 in the U.S. Strong expectation that in October we will have another rate cut. Very strong expectation that in December we'll have another rate cut. So that would be, another 50 basis points before the end of the year. Not quite the 100 plus that some are calling for. But as you look down this chart, you can see that the market is pricing in 100 plus basis points of rate cuts over the course of the next calendar year. Let's call it, and into late 2026. I mean, that is a pretty strong built-in view. Of course, the market has been expecting rate cuts for way longer than this, and we'll talk about that in forward curves. But one thing I want to highlight is we've gotten a few questions about, the ECB actually, Jackie, and how they are managing through this. So while we don't have specific slides on it, maybe this is a good time for you to talk about. I think the most interesting question is, from an EU standpoint, should the ECB have so much influence on domestic rates, regardless of some of the country-specific needs that you highlighted? And I picked this because I know Jackie's answer on this. But I think it's, I mean, it's a reasonable question.
It is. It's like that question was built for me.
Yeah.
So yeah, and We saw this through the Greek debt crisis, where you have a ECB and a monetary policy for the whole jurisdiction, which is just not right for the individual countries. I think because Greece, a kind of small peripheral country in the context of the whole of the EU, it maybe wasn't taken quite so seriously as it is today when we look at what's happening in France. And the one thing which is related to monetary policy, but for this, I'm going to make a slightly different point, which is when the bond markets are sending signals, which is what they're doing, then you need a central bank to stand behind the bond market. And obviously, France has a European central bank, and their own bond market is doing something quite different. So again, you have that, kind of challenge of trying to balance something that's right for the whole region versus what's happening in the individual nations. I thought the follow-up question would be does this mean there will be a breakup of the EU and the euro? So maybe beyond my lifetime, but I think this is just highlighting again the challenges that come from trying to have a blanket policy for countries that actually need different policies.
Yeah, it's a very real challenge. So let's briefly go through what's happening in U.S. interest rate markets, and then we'll talk about EU and UK interest rate markets. This chart shows you what the forward curve has looked like over the last year or so. What I find really interesting is the lighter green line. This is the forward curve today. And if we look out to that, mid 2027 point, it roughly intersects with what the forward curve was expecting rates to be a year ago in 2027. To Jackie's point, the journey to that has not been at all what the market expected a year ago. The market expected lots of rate cuts throughout 2025. We've just gotten one so far, but this is a very inverted yield curve in the short term. Going up over time, and the flat yield curve has certainly gone away from what we saw earlier this year. Looking at what that means for rate markets, some of the interesting strategies we've seen. We'll speak about some of the more common ones in a little bit. Is in the U.S., we have seen companies looking to take advantage of this inverted yield curve by locking in anywhere from 2 to 5 year pay fixed swaps because you're able to lock in call it somewhere in the mid threes to low threes range of a swap rate against again that Fed funds target rate, and SOFR is in that 4 to 4.25 range. So you can pick up some benefit right away on day one. Over the last 5 years or thereabouts, if you ignore that rate run up that we had as all central banks were catching up on fighting inflation post COVID, 5-year swap rates in the U.S. are they're not at lows, they're not at highs, they're kind of exactly where on average they've been over the last few years. But the shape of the curve is probably what's particularly interesting in driving some of the other strategies. Looks a little different though in the UK and
Yeah.
the EU.
Yeah, I mean, what has been the same is the expectation of rate cuts coming and the timing, and then that not really being what's played out, particularly in the UK market. So yeah, you can see from the Euribor forward curve, still an expectation of you could get another small reduction in rates from here. I think that inflation picture that we talked about earlier is obviously the key driver to that. I've seen a few people out saying, in fact, the next move from the ECB could be up, which made me sort of question, is this the shortest cycle we've ever had? It feels that we've only just started getting into the rate cutting cycle and potentially it's going to be over. But obviously you see that real steepening in the euro curve as well as the expectation that rates will rise over the medium term. When we move to the UK curve, I just think this really is quite fascinating. When you see, so the green line is where the forward curve is today, and if you look at where it was just a year ago, so the one basically right at the bottom of the chart. So we've been in this environment of, and when we talk to people every day in that whole time, people are just saying rates are coming down, so I'm just going to wait for rates to come down. And actually, when you look at what's happened in that time, is these rates, and remember, so these are the forward curves, which is where the swap rates and hedging pricing is coming from, have actually been increasing of that medium to long term. And as we've seen in short-term interest rates, i.e. base rate, come down, we've seen that long end continue to steepen further. I mentioned earlier about the UK budget on the 26th of November, and the expectation is that we'll get further steepening in the curve. And people say, oh, these kind of financial impacts, they're really interesting. And I say, well, they're actually political. And if the politicians don't make the decisions, going back to the fiscal discipline, then the markets will force them to do it in a much more brutal way. And
And
that's what we're seeing.
And we have seen it before,
Yeah. Yes.
many times. Not to remind us of was it the shortest tenured PM
Yes.
that there ever was in the UK?
Yes. The whole Liz Truss was in term shorter. She basically had the same term as it would be for the life of a lettuce, which is the comparison that the media made. But just to flip on to where we are in terms of swap rates across, again, UK on the left-hand side and Euro on the right-hand side. Kind of similar to what Amol was saying in the US for the UK, where, there's a little bit of a pickup where the 5-year swap rate, call it kind of 375, 377, versus where Sonia is today at just over 4%. But there is a bit of a concern, and when we start to talk about how people are kind of looking at the market data and trying to decide how to put hedging strategies in place, there is a real concern about fixing rates here when people think rates are going to fall further. My caution to that is we've had that expectation for quite a long time and it hasn't come through. So what else can you do to then make sure that you're risk protected, but maybe not locking in at a point when you think rates are falling? But of course, the other impact of Liberation Day and the interest rate differentials that are now really diverging, particularly between the EU and the US, has been the impact on the currency markets. So it's been a sell the US, sell the dollar story, really since the first tariff announcements came out. There's been a bit of stabilization recently, but from an outside lens, we're certainly seeing many of our international clients who are non-dollar based, not that they're saying let's asset allocate away from the US, but being much more focused on the FX risk that they are taking in their investments and trying to understand ways to mitigate that risk.
Yeah, it's really not the Sell America story that was being talked about, I think, in the second quarter of this year. It was really the Hedge America story, right? Which has had an impact on, and it is selling pressure on the currency. And so when we look at the chart here on the left, this is just indexing a few currencies to 100 at the beginning of the year. You can see that the dollar has weakened quite substantially against some of these currencies in a relatively rapid fashion. This is not common, let's say. And to your point, with interest rates, in some cases relatively higher in the U.S., you don't tend to see that with one another. It's not that the U.S. dollar has become an emerging market currency. But we can't ignore the data either. And to Jackie's point, one of the strategies we continue to see, certainly U.S.-based issuers taking advantage of, is looking at cross-currency swaps. As U.S. rates come down, some of the benefits that you get from some of these cross-currency swaps, for example, on yen, it was north of 4%, almost 4.5%. Call it 2 years ago. That's come down to on the order of 3.5%. That's still great if you're looking for a quick way to reduce interest expense and that's aligned with your currency profile. But you could see in the EU, for example, if U.S. rates really do come down another 100 basis points and the ECB actually raises rates, we could see some of that. We could see a convergence to closer to zero on some of that benefit.
Yeah, and I know we talked about the Swiss franc as well, which we have on the left-hand side of the chart. And one of the questions that we'd had earlier this week is, are we moving into negative rate territory already? Because Swiss rates at zero and the Swiss central bank will meet next week. So potential to be talking about negative interest rates again, which again will impact these currency moves. So it feels like there's a lot up for grabs in terms of opportunities, but do we think the market's underpricing some of the risks?
Well, let's talk about that. And by the way, it feels like just yesterday we had gotten out of negative rates. I can't
Yes.
believe we're back to it.
Mm.
But we have our next polling question is our third one. What risk factor do you view as most underappreciated by the market today? A, inflation. B, global trade policies. C, increasing sovereign debt yields. D, reduced central bank independence. E, none. Risks are well priced. I really want to talk, not to lead the witness here, but I really want to talk to anybody who says E,
Yes.
because it feels like we've talked about a lot of these risks. Where
Yeah.
would you? I think I know where you would place
Yeah.
your bets, but where would you place your bets?
I'm definitely in the increasing sovereign debt yields, because it seems in the Western world it's pretty universal, and with regard to the fiscal position that countries are facing, and a complete inability to cut spending. But instead of V, we actually debated, didn't we, whether we would put in the price of debt. So we're talking about interest rates and the underlying cost of debt, but we also here at Chatham, obviously, we're talking lots to our clients about their margins and spreads. And particularly in the real estate sector, it feels like some of the risk has been underpriced. Spreads are exceptionally tight, same in the bond market for corporate credit spreads. But we left that one out because there's going to be a whole other webinar on that in early November, which it's not on our screen, but I believe it's on your screen if you want to sign up and register for that. So we've given you an out with E and not put that spread one in there.
Yeah, but I mean those spreads, to your point, on the corporate bond market, investment grade bonds in the U.S. all time tights, all time lows on spreads. Feels really hard to see how they get lower, but they keep grinding lower. So,
Yeah.
well, let's see what our audience has said. If have you swayed them? Okay, first of all, we do have a few people that have said none. Risks are well priced, and those are the people that I think I want to hang out with.
The optimists.
Yes, I love it. But actually the plurality here, the greatest answer is actually for increasing sovereign debt yields, about a third of the audience. So very, very convincing, but kind of equally spread between inflation, global trade policies, reduced central bank independence. I actually just read a survey of CEOs recently, and actually that was their number one risk that they had highlighted. So central bank independence. So a lot to keep an eye on. So with all that, we've given a little bit of an overview of what's happening in the market. We've got a little under 15 minutes left here, and we want to talk about some of the strategies that we're seeing.
Yeah. So so just to kick off, getting a little bit more into okay, what do I do in this environment? And the questions we get is usually less so, what do I do, but more so, what are other people doing? So we've synthesized those insights into a couple of different topics just to give you a bit more information on what we're seeing when we're helping our clients. So the first one that I'll kick us off with is deal contingent hedging. So this slide just gives a very, very broad overview of what that actually means. The thing to bear in mind is that a deal contingent strategy can be wrapped into really any derivative structure. So it could be a deal contingent swap, it could be a deal contingent cap, it could be a deal contingent FX derivative. The contingency part of it is allowing you to take the risk off the table in advance of the final event. The final event could be the completion of an acquisition, or it could just be the signing of the financing. And what we've talked about when we've been going through what the interest rate market is pricing in is in all of this expectation of will rates be cut, when they'll be cut, there's been real opportunities to be able to take advantage. So sometimes the opportunity in the market doesn't always line up exactly with the date at which you're going to be putting any instruments in place. So this deal contingent wrapper, say it can be applied in M&A situations, it can be applied in carve-outs, take privates, or just future financings, is a real flexible way to kind of pre-hedge the risk. The one thing just to take away from this slide is it is not an option. It is an obligation, but an obligation that's contingent on the event. And of course, the definition of what that event is the critical part of negotiating these type of structures. So I'll let them all go into a bit more detail on one to bring it to life a little bit.
That's right. So we'll talk a little bit on the previous slide. We talked at a high level about how and why companies would use deal contingent hedges. Jackie mentioned, and one of the common uses that we've been seeing recently has been using it for interest rate swaps on either, as you said, a future financing that might be closing. It could be for project finance. It could be data centers. A lot of those are being built around the world right now, or in other infrastructure type of projects. Could also be for buyout or a spinoff of a company when you're anticipating closing at some point in the future. And given how volatile rates have been, as we've shown, this becomes really critical to evaluate. I think, as Jackie mentioned, there are a lot of let's call them bells and whistles in these types of transactions. What really defines what is deal contingency? One of the biggest mistakes that companies can make in pursuing these transactions is, have deal contingency definition in their derivative that is not linked to what it truly means to close the deal on for whatever that underlying transaction is. In this case, it could be a financing. You certainly don't want a swap with no financing to attach it to. That was the whole point of having this deal contingent feature in there. There are a number of advantages of pursuing these types of strategies on interest rate swaps. We say here that there's no upfront cost, and that's true, but there is an incremental cost for the risk that is being passed on to your counterparty on these types of transactions. There's also a lot of timing that has to be considered on these types of transactions. These if you are having traditional banks underwrite your debt, certainly we've worked with our clients to get these transactions put in place in 24 hours, which is quite rapid. I don't want to say that that's the standard, but
It's not the usual.
yeah, but it can happen. But if private credit is involved, these are institutions that don't have derivative capabilities. Certainly not this type of a derivative offering. That can be really challenging because now you may have to bring in a bank to actually underwrite not just the derivative but the entirety of the transaction. You're also welcoming another party into the tent, and given all the concerns around these types of transactions and confidentiality, it brings in additional factors to consider throughout this whole process. I think that is one of the big reasons we've seen just a rise in the usage of advisors like Chatham and on this. And I think when I go through our database, we've been doing deal contingent hedging for we're advising clients for over 20 years on this. I remember the first one that I ever worked on, and thinking this is so exotic. And while pricing has come down a lot over those 2 decades, the complexity has not. In fact, it's only gone up. And with the term sheets that we have and the data that we have, we've been able to really help streamline that process and navigate some of the really difficult decisions that companies have to make, and being able to put these trades in place.
So just a quick question come in, which is, can all banks provide deal contingent structures? And I think certainly that no is the answer. But we would say that in all the years where we've been structuring these for our clients, the number of banks that are able to offer them has grown a lot. So yeah, the global investment banks certainly are dominant in this sector, but also some of the domestic banks in various countries. And we've worked with a lot of banks to help them understand how they can be structuring these. But so maybe gone from a handful to kind of dozens of banks that would be able to offer this product.
Yeah, and I think the use cases have also increased over the last few decades of it. So that was one strategy. We want to quickly transition to another strategy. We won't spend too much time on this, but I think this is a really interesting one, particularly given the shape of the yield curve in the U.S. And we'll show some data that will help ground this and why we're talking about it. But interest rate collars, a product that's it's been a long time since we've talked about it as much as we have with our clients, and even supported the execution of a lot of these transactions. For those not as familiar with collars, it's really the combination of a purchase interest rate cap and a sold floor. And what it allows you to do is float in a band of interest rates. And you see here, this is a relatively tight band, float between 5 and 4.5%. These are often structured as zero cost structures, i.e., if the cap was going to cost you $1 million, we figure out the floor strike or the best case scenario on interest rates that you can have that would allow you to pay and finance that cap premium. They don't have to be structured as zero cost structures, but the popularity really has been, I'd say, widespread across all different industries. It could be, we've seen a lot of financial institutions using this, to protect on, depending on how their balance sheet is positioned. Certainly multinationals, real estate firms. This is any type of infrastructure firm to the extent that it makes sense within the context of their capital structure. But this is again another credit product. It's like a swap. It's an interest rate cap you can simply purchase and not pay for, and not worry about your credit worthiness. You worry about your counterparty's credit worthiness. But in the case of an interest rate collar, because you are essentially selling a derivative, you're selling an option, a floor, your creditworthiness is relevant. So finding the right counterparty is critical, and being able to navigate some of the pricing challenges inherent in pricing the credit is really important. This slide just shows you why we're talking about it. This is based on the data we have of our U.S. clients, and we have never seen more collars executed than we have in the last few years, either in terms of notional or in terms of number of transactions. Jackie and I have been doing this for a long time, and certainly this is a peak, and we see that 2025 is on trend to even surpass what we saw in 2024. So we're sharing this as another alternative strategy that, if you've been looking at swaps or caps, it's worth evaluating, and feel free to reach out to either of us or your relationship manager or your team member at Chatham that you work with to get a better sense of what this could mean for your particular investments.
Thanks, Amal. And there was a little white paper to download as well on the deal contingent. I should have highlighted that, which gives much more information than our high-level overview. So now we're down to our last few minutes. So this is our final poll question before we go into our last slide or two. So we've talked a lot about how the market's been giving us opportunities to take advantage of what's been priced in. And what we've seen is that many of our clients are trying to kind of preempt replacement hedges and not waiting for the expiry. So we're keen to hear if that is the same for you. So the final question is, how are you evaluating upcoming maturing hedges? Are you planning to re-hedge just at maturity, so wait for it to happen and then hedge? Are you consistently monitoring the markets to re-hedge? In the process of aligning next steps with my Chatham advisor, or you're not planning to re-hedge at all. So either because the loan is being repaid or you're planning to move to a floating rate basis. So we'll just give you a minute or so, and I promise I'll get through the next two slides in the last 2 minutes as we wrap up.
Record time. And then maybe we can start talking about it now. I think, one of the themes that we've seen is, a lot of our clients wanting to be more proactive and take a portfolio view rather than just being reactive to when those hedges mature. What are some of the takeaways from those conversations? I know you've had a lot of them.
Yeah, so it's definitely being, I'd say, much, much, much further in advance. The clients are looking to say, what does this re-hedge look like? And even if they're not planning to take action to execute it there and then, they're looking for much more accurate current pricing to build into their financial models to say, I know that this swap or this cap's maturing. What do I need to build in for the next 3 years for the cost of what that will be? And that's happening, 12 months in advance of maturities. The other thing is people are looking at it on a portfolio basis rather than individual trade by trade. So delighted to see that our clients are consistently monitoring the markets to re-hedge, and there's lots of resources available to help you do that. Chatham rates, I'm sure you're all already on that. But just to wrap us up, I mentioned that clients are certainly looking at their overall hedge ratios and hedge replacements across the portfolio, looking at kind of blended positions, making sure that they're not waiting to replace 5 or 6 hedges at the same time. So this is just a little snapshot from Chatham's platform. Again, it's all anonymized, looking at the debt and the derivative position together, looking at the fixed floating mix, looking at how that changes over time. And then from there, really looking at how we can then look at the maturities coming up and start to build in assumptions as to what the cost of they will be to replace. As I say, this doesn't always lead to an execution decision there and then, but it's more about the knowledge and information about what it will look like. If I wind back to 2018, 2019, you would get the call from a client to say, oh, my cap matures tomorrow. But interest rates were so low, and people weren't really that concerned about it. So yeah.
Yeah, that's great. And as we are coming close, to the close of our webinar, we've done our best to answer your questions, but I will admit that there were a lot more questions that we had an opportunity to answer. So we'll do our best to follow up with all of you on those questions as much as possible. But do want to highlight very quickly the resource list. There's a lot of information on the page in front of you that you can download. And before you go, if you do need that CPE or CTP credit, feel free to grab that as soon as we close this. And if you have any questions, we're happy to address them as a follow up. But I think the big takeaway here for me is, I know for you it's all about sovereign debt yields, Jackie. But I think this is a unique time where we are looking at some fundamental shifts in how capital might be flowing because of some major macroeconomic policy changes. And the theme from our clients has been, let's be proactive, let's look at alternative strategies, and let's not wait until the moment comes that we actually have to hedge, but let's actually be well in advance of it. And we've been working with our clients to really arm them with the information and the data to be able to make those decisions.
Great. Well, thank you, Amol. Thanks for joining us.
Thank you, everyone.